So today we're going to look at, so this is week one, we're going to look at how to grow your business. So like I said, we're going to give some ideas, areas to look at, how they impact turnover, net profit, gross margins, etc. There may be some things you've thought about before, some things you haven't. So if you need to pop something in the chat or just raise your hand, just let me know or shout out. That'd be great. But we'll run through this for an hour and then at the end we'll do a Q&A. So let's just check the PowerPoint's up. So Charlotte, you're on page 1. Fine. Right, so every business is different and different people want different things. Some people may be happy with a lifestyle business, but some may be working to grow to sell the business, whilst others may want to build the next Amazon. So whatever your particular goal is, for life or for business, you need to be clear on what success looks like for you. Now, this is the agenda we're going to cover for the next 12 weeks. So week one today, we're going to look at demonstrating how to track and improve just a few key growth drivers, those that apply to just every business, and you can almost certainly grow your revenue, profits, and equity exponentially. However, every business is different, as some of the growth drivers are easier to move than others. Also, some drivers have a far more dramatic impact than others. So it's important to understand exactly how each applies to business and which ones to focus on first. In week two, we'll explore the key business drivers in more detail. These drivers are critical for effective management and sustained controllable long-term business growth. We'll then model some key scenarios to illustrate how seemingly insignificant improvements implemented over time compound to deliver amazing results. We'll then move on to look at each key business growth driver in turn and share some invaluable low-cost and even better no-cost strategies you can implement in your business. We'll start with the one that is most totally under your control. So week three, we'll identify the opportunities for quick win cash generations and cost savings, ways to be exploited in your overheads. Week four, we'll focus on the strategies you can implement to improve cash flow. Effective cash management strategies are critical for sustained profitable growth. Far too many otherwise profitable businesses fail for all the wrong reasons. In week five, we move on to gross margin. It's crucial to ensure your gross margin rates are optimized, because by far, the fastest way to increase your profit is through improving your gross margins. In week six, we'll focus on customer attrition. So some would argue that this is the most important business growth driver, and it's one that many businesses completely neglect. How engaged are your existing customers? Maximizing engagement and satisfaction improves customer retention and makes it much easier to cross-sell, increases referrals. In week seven, we'll focus on finding the hidden opportunities that lie in existing customer base. You can increase sales by 40%. What would you do? What would this do for your business? And why 40%? Well, 40% is the average potential increase in sales a business can achieve if they successfully upsell and cross-sell, depending on how well you look at it. Either sell more of their existing product or services to customers, or put it another way, satisfy more of their customers' demands or someone else does. In week eight, we'll share simple strategies for increasing sales without having to find new customers. Total number of transactions times average transaction value is more sales. These two KPIs, or key performance indicators, are critically important because improvements can be incredibly quick and easy to achieve. In week nine, last of the growth drivers, but by no means least, we finally move on to looking at new customer acquisition. You'll notice that if we move to acquisition last, i.e. after we've worked on everything else, the opportunities covered in weeks 1 to 8 will highlight significant opportunities for growth and increased profitability in your existing customer base. At the end of the day, only by acquiring good quality new customers can you really look forward to growing sustainably in the long term. In week 10, we explore your number. Exactly how much wealth do you need to accumulate and by when? Whether you plan to retire or not, it's important to know how much wealth you need to live the lifestyle you want on your terms and on your timescales. Some business owners keep working longer than they should, and they are the lucky ones. Far too many struggle. They fail to create enough equity in their business to live the life they desire. What's your number? Week 11, whether you plan to exit or not, you should always strive to run your business in a way that makes it exit ready. To do the job without compromise typically takes 4 to 5 years and sometimes much longer. An incredible 90% of all businesses are unsaleable. Of the remaining 10% are eventually marketed to sell, an unbelievable 80% fail to sell. And of those that do sell, less than 5% achieve their target valuation. Here we'll discover how you can stack the odds in your favour. And finally, for week 12, with all the planning done, we show you how to prepare your 5-year, 3-way forecast to properly plan your future with a robust forecast, because without this, it is impossible to track your performance versus plan, whilst you work systematically to grow your business and secure your financial future. So back to today's agenda, how to grow your business. So we're going to move on to the next area. Okay. Charlotte? Okay, so those of you who have read Lewis Carroll's book, Alice in Wonderland, will recognise this extract, the conversation between Alice and the Cheshire Cat. Would you tell me, please, which way I ought to go from here? Asked Alice. That depends a good deal on where you want to go, said the cat. I don't care much where, said Alice. Then it doesn't matter which way you go, said the cat. If you genuinely don't care what happens to you and your business in the future, this might be okay. But for everyone else, we really do need to know where we want to be in the future, in both our professional and personal lives, and we ideally need a time frame for when we want to get there. So this part's about you. So close your eyes and picture yourself in the future. In your ideal world, looking back on all that you have accomplished. It could be to achieve a yacht, a second home, somewhere in the sun, the kids through college, but set up with their own homes. Looking at these goals in 5 years is going to help you to determine what you need from your business. What will you encounter on your journey? What dangers will you need to address? What opportunities do you have that should be exploited? And what are the key strengths that we can build on as we make our vision a reality? We all have things that get in the way, be that having to work all hours that God sends, having to deal with people or situations that are less than ideal. Be clear in your own mind, what are the things that might conspire to prevent you from achieving your life dreams, goals, and aspirations? To me, all entrepreneurs are heroes. Anyone who has the guts, willpower, and determination to become an entrepreneur, to go into business, to employ people, and create the wealth to support them, their families, and contribute to the wider community is a hero. But the odds really are stacked against you. The statistics make for painful reading. If we look at the statistics from the ONS, in this case, the survival rates for businesses born in 2014, only 42.5% will make it to year 5. You have to be slightly crazy to gamble knowing the statistics. Don't forget 2014 to 19 was pre-COVID. Who knows what impact COVID will have? But if we think about it, simply surviving to still be in the race at some point in the future is only one small part of the journey. To actually get to the finish line, whatever your plans are for the future, at some point you will have to exit. And the statistics for company exit are even more worrying. So for the 42.5% of us that are successful, the successful minority who survived to year 5, more than 90% of businesses simply wound up without being marketed for sale. This leaves 4.3% of businesses. Of the 4.3% who actually put their business on the market, 80%, that's 4 out of every 5, their businesses will not sell. Imagine the impact on those poor entrepreneurs whose businesses was the part of their retirement. Some have no choice. They have to keep working because they can't afford to stop until it's really too late. So statistically, less than 1%, just 0.86% of businesses will actually be sold. Of those that do sell, less than 5% achieve their expected valuation. That leaves you with a 1 in 2,222 chance of a successful exit. No one in their right mind would gamble on those odds, which is why, in my humble opinion, anyone who starts up a business is a hero. Because businesses create jobs, and jobs create shared wealth, and without sufficient wealth to go around, society will become rather unpleasant for all of us. So let's look at some simple strategies we can apply to beat the odds. So, when Sir David Brailsford took over a British cycling team in 2002, we had only won 1 gold in 67-year history. In 2008, the Beijing Olympics, the British team won 7 out of 10 gold medals and repeated that success in London 4 years later. The team then went on to win 3 of the last 4 Tour de France events. How did they achieve this extraordinary success? By breaking down everything that goes into competitive cycling and finding ways to make small 1% incremental gains to achieve an aggregated increase in overall performance. So David Brailsford said, perhaps the most powerful benefit is the process created a contagious enthusiasm. Everyone starts looking for ways to improve. There's something inherently more rewarding about identifying marginal gains. Autonomy is similar to a scavenger hunt. People want to identify opportunities and share them with the group. Our team became a very positive place to be. So, some people are perfectly happy and like things just the way they are. Some would just like a bit more success and spend more time doing what they do rather than having to go into work every day. And some people want to be the next Apple or SpaceX and do something really amazing. Everybody is different, but we all have discovered with COVID, none of us can take anything for granted. We need a plan and we need to understand the key drivers for success. And above all, we need to measure what matters. So, are you measuring the right things in your business? The vast majority of businesses are using lag measures, a situation not helped by most accountants who in the vast majority of cases only focus and report on outputs, and worse than that, they focus on what, for most of us, is already ancient history. Let me give you some examples of outputs: sales, profit, cash in the bank, and when delivered as a set of year-end statutory accounts that arrive 6 to 9 months after the year-end, these are all outputs that focus on ancient history. Therefore, and they are useless for effective management control. So let me now give you some input drivers, critical input drivers that you need to understand, measure, and review on a regular basis. There are some things that apply to all businesses. The terms may change slightly, but the fundamentals are by and large the same. So, should you try and increase average transaction values? Can you persuade customers to buy more frequently? Should you seek to improve profit margins? Should you concentrate on cutting overheads? Should you focus on all your efforts on new customer acquisition? What would improved customer retention make? Or should you focus on all of these to make incremental improvements over time? Okay, so Alex's company, KPI, right? We'll be using the same company as we go through the next 12 weeks. So let me introduce to you Alex and Alex's company, KPI Software. It's totally fictional, but there are some real numbers in here. Here we can see a typical profit and loss account. We can see revenue is flat, slightly down year on year, so Alex's business is not growing. However, Alex has managed to improve the gross profit margin by 1%, which has increased profit by nearly £10,000. Overheads are reduced compared to last year by exactly 10k, which has increased net profit by 60k last year and nearly 80k in the most recent year of trading. Alex, in common with many other business owners who pay themselves the minimum through PAYE to save on tax and national insurance, prefers to draw the majority of their income through dividend payments. So with an extra 20k profit, presumably Alex will be looking forward to a substantial and increased dividend payment this year versus last. We'll come back to that later. For now, let's look at things Alex can do to improve KPI Software's performance. Firstly, values. So, do you know your average transaction value is? If you provide a wide range of products or services, you may need to segment your income streams. The most obvious and simple way to increase transaction value is to simply increase the selling price. More about this in a moment. Let's consider an example of a bundle of upsell scripts. Do you want fries with that? Or do you want to go large? This simple strategy makes a huge difference to McDonald's sales and their profits. Are all of your clients aware of purchasing all the things they could from you? Many businesses offer lots of products and services, but their clients typically don't purchase most of them for one simple reason. They're unaware of their services and that they exist. Is increasing the average transaction value of one of your key objectives? And if so, is this KPI included in your monthly management pack? Total sales are a function of two things: average transaction value and the number of transactions. So, do you know how many times your average customer purchases? Example, a pub. The landlord frequently knows their customers by name. They know their favorite drink, and whilst you're there, the landlord frequently chats to you as though you're one of their best friends. But what happens when you leave? In the typical pub, the landlord has no way of influencing you or encouraging you to purchase again. They simply wait for you and the rest of the customers to come back, and that could be a long wait. So an obvious first step for every business is to make sure you have your customers' contact details and communicate with them effectively. If you don't have contact details, how can you communicate? And if you don't have if you don't measure purchase frequency, how will you know if your efforts to persuade customers to purchase more frequently have been successful or not? Is increasing transaction value one of your key objectives? If so, is this part of your monthly management pack? Now, do you know what your margins are? Increasing prices is one of the fastest ways to improve margins. The increase in sales price goes straight to the bottom line. But what if you cannot increase prices? Let's take an example of a car showroom. The margin of the car sale is wafer thin in percentage terms. But what about the matters? The mats, the finance, the maintenance contracts. In all likelihood, the showroom makes more money on the high margin extras and the finance than they do on the car itself. And let's come back to McDonald's. When they sell a meal, the margin on the actual burger is not great. But they make most of their profit on the upsell, chips, or the fries if you prefer. And the soft drink that have huge percentage gross margin rates. By selling high margin add-ons to augment the main purchase, the average margin can be massively increased. What high margin upsell items could you bundle with your core products and services to increase your gross profit margins? Is increasing profit margins one of your key objectives? And if so, do you review and discuss gross margins as part of your monthly management meetings and information pack? Okay, so discounts. So frequently, the fastest way to increase profit margins is to stop discounting. Conversely, the fastest way to decrease profit margins is to offer discounts. So let's look at that in more detail. So scenario 1, no discount. You sell at your current price, which is £100, cost of goods are 70, so you make £30 profit. Scenario 2, your sales team offer a 10% discount. This reduces your selling price to 90. The cost of goods is still 70, so you make £20 profit for each unit sold. Your profit is reduced not by 10%, by a third, down from 30 to £20, sorry. Scenario 3, client feedback indicates that you increase prices and up they go by the same 10%. So this scenario, your selling price is 110 and cost of goods is still 70. So now you make £40 profit for each unit. Your profit has increased not by 10%, but up by a third now, from 30 to 40 per unit sold. By how much would you have to increase your sales volume to achieve a 33.3% increase in net profits? We'll come back to this when we go through this in more detail on gross margins in session 5. So are you tracking your fixed overhead costs to make sure you're not paying too much as prices fluctuate? Just like petrol, suppliers put prices up quickly when their costs go up, but what happens when their costs fall? Take utilities. 80% of UK businesses don't bother to shop around, but in most cases, the minimum potential saving they could be enjoying is 20%. But savings are frequently around 40, and in some cases as much as 60. But the electric that comes out your socket is exactly the same. Do you systematically analyse your historic payments to identify opportunities to make savings? And wherever an opportunity can be found, do you actually follow through to maximise your bottom line profitability? It's also important to look for expenditure that delivers an ROI, a return on investment. For example, sales and marketing expenditure, until recently, was not uncommon to find businesses still paying for yellow page advertising, long after they'd ceased to generate new sales inquiries. Are you measuring and reporting an actual overhead expenditure each month compared to your plan? And for any expenditure that you should be delivering an ROI, are you taking steps to measure and report on your actual ROI achieved to find ways to improve this still further? So what inputs do you need to focus on to improve new customer acquisition? New customers acquired is an output, a lag indicator. Inputs are leads generated from XYZ lead source, multiplied by conversion rate, and there is an extremely important variable to understand in relation to new customer acquisition, the lifetime customer value, because not all customers are equal. What makes a good lead, and where are your best lead sources? Which lead sources are the fastest, easiest, and lowest cost to convert, and in parallel with that, which lead sources typically deliver the best quality new customers? Measured by your total profit, you enjoy servicing those customers for the duration of the time they continue to do business with you. Do you record the full cost of your new customer acquisition? And do you compare this with your lifetime customer value? What is the full return on investment on your new customer acquisition activities? If you're not reviewing your new customer acquisition data, or more to the point, the inputs that must happen to get this to where you want it to be, isn't it time you made measurement and reporting a systematic part of your monthly management review process? By continuing on the topic of lifetime customer value, are you measuring and reporting on the retention and taking action to improve? If you are, congratulations, you're part of the very elite few who do. It costs so much to acquire a new business. Why do so many businesses seemingly totally ignore their most precious business asset? This is where all your money comes from, your existing customers. Let's use an example. True story, a stationery supplier. Dave, the MD, was very proud of his 850 clients. He proudly explained that an active client purchases every 1 to 2 months, so it's great business to be in. But when he analysed Dave's customer data, we discovered 600 to 850 customers of his 850 customers, had not purchased for more than 6 months. David went pale when he realised the truth. He had been losing clients without even knowing it. As you can imagine, if he didn't know he had lost most of his clients, he certainly did not know why their customers were leaving, and he clearly was not able to do anything proactive to address the problem. So finding out why customers think the service, find out what customers think of the service they receive from you. What do you think you could improve on? Are there things you could be doing to help them? And are there other problems in your customers' lives you could solve? In other words, things could be selling to them to help make their lives easier. People love to feel valued and provided you do it properly, they are happy to share their opinions and let you know how they think you can improve your business and the service they receive. So here, retention and acquisition, right? So we're going to highlight the new customers acquired. So currently, we are down from 98 last year to 79 this year. So there's a 19 customer reduction. Does anyone know what those 19 additional customers would have generated in sales? We can see here that they have purchased the same amount as an average client. Total revenue lost by acquiring fewer customers is a massive £108,700, which for a business turning over £1 million represents a 10% increase in total sales revenue. And what about the leaky bucket, customers seeping out of the business? How are we doing on this metric? We can see that retention has deteriorated year on year, down from 55% 2 years ago to just 51% in the last year. That is a 4% reduction in retention. Or how look at another way, 4% fewer customers purchasing. So again, we can easily work out what those customers would have purchased if Alex had managed to retain them. It's another £44,600 lost sales. Add those together with that, and we have over £150,000 lost sales, more than 15% potential sales growth. If you recall from Alex's profit and loss statement, gross margins last year were 35%. So £150,000 at 35% gross margin equates to £52,500. And this is profit that's leaked out of Alex's business, out of his bank account, and ultimately £52,500 of bonus that Alex will not be able to draw as a dividend at the end of the year. More about dividends in a moment. Excuse me a second, stuck in the sun. Okay. So growing your business. Let's look at what happens when we grow our business. Alex is ambitious and is keen to grow the business. Having recently discovered that pay-per-click advertising and Facebook advertising generates good quality leads that are converted to sales, an ambitious plan to grow revenue is agreed. Alex has included marketing costs in the overheads. So for simplicity, we're going to assume Alex's business ratios remain constant as sales increase. So let's see what happens to Alex's business when we grow revenue by an aggressive 50%. We can see sales increase by £500,000, up from 1 to 1.5 million. Gross margins of 35% and overheads of 27% delivers a 50% increase in new profit, up from 79,420 to 119,130, and an increase of 39,710. Is that a success, or are you bankrupting your business? We need to be very clear on what happens to the cash in the business. or more to the point, flow of cash into the business. So let's use water to illustrate what happens. In most cases, you have to start by buying stuff. That is typically in the form of goods and labour that has to be paid for before the finished product can be created, delivered, sold, invoiced, and payment received. You'll start to get the picture. So the stuff we buy and ideally receive credit terms for, we call our creditors or accounts payable. So this is effectively money your business is borrowing from your suppliers until you get around to paying for it. In most cases, there is a delay whilst raw materials and labour are converted into a finished product. So in Alex's case, there are no tangible products on the shelf. As a software business, staff labour is required to create finished product. For a retailer, wholesale business, they may simply be stocked on the shelves, waiting to be sold. And for a manufacturer, a builder, or a contracting business, the finished product is a combination of materials and labour that could take months or even years to convert into finished product. So all of this labour and materials you have paid for sits in the business as stock or work in progress before you can eventually sell it. At which point, if you provide credit terms, the stuff you sell will have to be recorded. This is referred to as debtors, people who owe you money, where you're effectively playing bank and lending them your hard-earned cash. This is recorded as accounts receivable, and the time taken to collect it is typically reported in days, which we call debtor days. So we have to keep in mind the issue of this. There is a delay between buying and paying for stock and labour, and the time the finished product is sold and paid for. And that time delay can be considerable. And in the meantime, it all sits in the business, recorded on the balance sheet, tying up cash or working capital as it flows out and eventually back into your business. So what happens when sales increase? You buy more stuff that sits on the shelves, the stock and or work in progress, and eventually it gets sold. And as you sell more, you buy more. You buy more, you hold more stock, work in progress, and accounts receivable or debtors increase. And so cash flows out of the business faster than it flows in. So the bucket of cash needed to fund growth has to increase in size. Or if you think about this as a bank, you need a bigger and bigger bank balance to fund that stock increase. So let's look at these three drivers and think about what we can do to mitigate or reduce stock, work in progress to improve cash flow of the business. You cannot manage what you cannot measure. So first and foremost, do you track the time it takes for you to pay your suppliers? How often do you review and discuss this KPI as your key performance indicator? When does your team discuss and debate things you can improve, your creditor days? Who in your business is given responsibility for asking suppliers for and negotiating better terms? Do they have targets for improvement? Have you benchmarked other suppliers? And if yes, if benchmarking is benchmarking a systematic process conducted at predetermined intervals throughout the year? Or is it a case of waiting for a new potential supplier to arrive in the hope they will offer better terms? Do you or whoever within your business is tasked with establishing what other businesses are paying for the same products or services, make sure you're not paying too much over the odds? The key thing in most cases is that simply by reviewing a specific number or target for improvement on a regular basis is enough to keep the KPI steady, or better still, moving in the right direction. Who is responsible for recording and reporting how much stock or work in progress you have tied up in your business? How often do you review these critical business cash flow drivers? An example is a manufacturing business managed to reduce stock levels by getting rid of slow or obsolete stock. In so doing, they moved their stock turns, the number of times each year they effectively sold their entire stock to make profit, from 3 to 8. Unfortunately, for this business, this was in part achieved by getting rid of near £250,000 of redundant stock. The key point is that only by understanding and working to optimize stock and work in progress, and by having accurate, up-to-date information to work on, you can effectively manage that stock. Another example, a retail business selling print consumables rationalized their stock by only holding the fast-moving items. For the rest, they explained to clients that there was a lead time for delivery. This led to customers purchasing and holding a buffer stock in their own stationary cupboards. And when they wanted more, they ordered 2 or 3 days before. They needed to replace the stock, meaning the retailer was able to realize the same profit without ever having to hold that stock. The ultimate business model for this is the drop shippers, who get paid before they even place the order for the goods that are in some cases shipped directly to the customer without the supplier holding any stock whatsoever. Once again, only by recording, reviewing, and brainstorming ideas to improve your KPIs over time can you be confident your business is under control and moving in the right direction. But once again, you cannot manage what you cannot measure, and you really do need to manage this one. So do you record, track, and review how long it takes your customers to pay you? There's no point making a sale if you don't get paid for it, or if you have to wait too long to get paid. How often do you review and discuss debtors? When does your team discuss and debate things you do to improve your debtor days? What are your targets for improvement? For example, reducing your debtor days from X to Y and by when? Do you know what the best performing businesses in your sectors are achieving? Who within your business is responsible for managing and reducing debtor days? Do you have a clearly defined credit control process to get invoices raised immediately to remind customers when payment is due? And do you use any apps or automation to streamline and add professionalism to your credit control process? If any of the customers mess you around, do you have a robust escalation process? And do you put your bad payers onto pro forma payment, i.e. asking them to pay you before the goods are shipped? The impact of improving the cash drivers can have a very profound impact on your company bank account. As you improve your 3 cash flow drivers, creditors, stock, work in progress, and debtors, the amount of money you need in your business tied up in stock reduces and reduces and reduces. It can now be used for more other productive applications. Let's look again at Alex and KPI software. We have a healthy increase in net profit. Alex wants to draw £40,000 in a dividend, but there's a problem. With a 53k overdraft, that is simply not affordable. So what is Alex to do? First off, tell the family. There'll have to be a massive tightening of the belt. Explain to the children that this year's holiday plans are off. Christmas and birthdays will have to be a lot more frugal, and any thoughts of home improvements will have to be postponed. One can imagine the pressure this will put on Alex's home life. So we need a plan to solve the problem. Based on the need to solve the cash flow problem, Alex does what most business owners would do to get more cash in the business, look to increase sales. So if you recall from earlier, we mentioned Alex had discovered that investing in pay-per-click advertising generated leads that were converting, growing sales, becoming a relatively easy, predictable process. What would you do if you have 50% more of everything at work? 50% more stress, pressure, hassle, and even more time at work, presumably. As we already know, 50% increase in sales generates an additional 40k in profit. But what about cash? Well, we need to understand what we need to know is happening with debtors, creditors, and stock. As we can see here, read this slide. Debtor days have moved from 69 to 72 days, with nearly a 200 grand tied up in accounts receivable. With sales increasing, if it continues to take 72 days to get invoices paid, the debtor days will increase to nearly £300,000. Creditor days have moved from 31 to 27, so accounts payable. They're currently under £70,000. This would increase to just over 103, so the net impact on the bank, even with an additional 40k in profit, is a deterioration. The bank overdraft counterintuitively does not improve, it gets worse. I hope Alex has a good relationship with the bank manager, because the business is going to need an additional 25k to continue trading. Presumably, with the director's guarantee, how will that go down at home? Not to mention another difficult domestic discussion, still no holiday, still no Santa, and a load more pressure on Alex due to the difficult home situation, which is presumably not helped by already having to do 50% more of everything at work. So what would happen if Alex focused on one more key driver, debtor days? Let's assume, for argument's sake, Alex outsourced credit control to the company accountants. They set up the required processes and procedures, and let's be honest, Alex was great with customers discussing and agreeing sales, and the more prickly topic of payment was not the top priority, especially with 50% more sales to get out the door. So by focusing on debtor days, if Alex now outsourced credit control, the team are able to reduce the debtor days from 72 to 40. As you can see, even with a 50% increase in sales, accounts receivable reduced from 197,497 to 164,581. That improves cash position by 32,916. Add that to the 39,710 increase in profit, and the 34,346 increase in accounts payable, the cash position will be improved by a massive 106,972, moving the bank balance from 53 overdrawn to nearly 54k positive. Now that would make much more of a pleasant home discussion, domestic harmony restored. All Alex needs now is more time and less stress at work. So let's look at one other potential scenario. So, what if Alex had not tried to grow the business by increasing sales, but simply outsourced his credit control? As we can see, the impact of that alone would have moved the bank position from 53 minus to 35k positive. Just think about the difference in the two scenarios. Cash balance with 50% sales growth and better credit control versus the cash balance with credit control only. First, move the bank balance from a huge overdraft of 53. First moves the bank balance from an overdraft to 53k positive, whereas the focusing on credit control moves the bank balance to 34k positive. So if Alex wants to get a dividend paid, enjoy less stress, and still have time spent with the family, enjoying all of the fruits of labour, the best way to do so may not be the obvious as it first appears. So to recap, there's 6 business drivers, plus the cash flow now makes that 7. We have briefly looked at how to alter just the 2 of the drivers. We have briefly looked at how altering 2 of the drivers can have a profound impact on the business profit, cash flow, and stress levels. Not all drivers are as easy to alter as the others. Some are much easier, some are much harder, and some more to the point depending on the situation and what you're trying to achieve. Some have far more profound impact on the business than others, so we really do need to understand that in more detail. However, that is a topic for our next session, but for now, are there any questions?
No, I don't think I've got any questions. That was really interesting, actually, and has given me a couple of ideas that seem so obvious now you've highlighted them.
Yeah.
Especially the source of customers. I have a very, very detailed cash flow, but what I'm going to add now is who the casting director or producer was, so that I can see how much repeat custom we're getting, although their wants obviously vary from production to production, but just how often we're being used and who I want to develop. That's brilliant. Thank you. I'm going to do that today.
That's always the key thing. I mean, obviously we do your accounts, Linda, and I know that you do have a lot of people that pay late, so it's always a good area to focus on.
Yes, yeah.
Because cash flow is key.
Yeah, it's the source of the work plus also how long they're taking to pay. Yeah, that's a kind of double-edged idea that it just hadn't crossed my mind, but brilliant, thank you. Yeah, the information was there but hidden in the database, but now I'll make it more transparent.
Yeah, it's finding that way how you can do that. I mean, it's the simplest way there, as you saw. I know the best. Yeah, you can increase your business by 50% and do the debtor days and chasing your debtors. But I think the key thing there was the quickest way was to look at sorting your debtors first.
Yes.
Then look at focusing on building your business, because you could do all this work for people and not get paid still. It's just not worth it at the moment. So yeah, build the easy way and then do the hard stuff. Have your holiday and then build the business.
Oh, I'm off now then. So,
You're always off, Linda.
That positive part, so identifying who is buying, so that's also quite important to my business, because then we can work on them and find out what it is that they're buying each time, what qualities they're looking for. So no, that's great, because the actors are stock. So
yeah, it's also very good. You need good bookkeeping, good accounting to get these sort of results, because unless you've got that behind you, or you've got someone in your office who can put all that together, it's never going to work. So by ensuring you're keeping on top of it will always make life easier and make those things happen.
Yes.
Stephen wanted to say something as well, David.
Sorry, Stephen.
Yeah. No, I was just saying it's very informative. We've sort of stretched creditor days as much as can, I think, which has been good. It's just those getting the debtor days down. The problem you've got is that if you stretch your creditor days,
you could find yourself in trouble in that, those creditors could then say, well, we want cash up front. So it's easier for you to go and get your debtors to pay you earlier than for you.
We're right on their terms. We're all within their terms, but it's right, literally at the.
You'll find out in the later sessions where that can be quite troubling. So
yeah, I bet.
But yeah, I think if you can try not to stretch it too much so that it pushes you out of their good area, let's just say.
Yeah.
Because the worst thing for you would be that they say, oh no, you prepare some cash today rather than in 30 days. That's the issue with that.
Outsourcing something to consider. The only issue with that is it's such a, I don't know, there's always that fear that it's going to put customers off. It's not like individual people that we're sort of working for, it's companies that we work for. So it's other, if all of a sudden they've got just an outsourced company chasing them and going.
Yeah, or what a lot of people have started to do recently is utilize the accounting software that does have the automatic function in it to do that. So you set the terms on there, and as long as you set up a template so that it looks pretty professional, it doesn't look like it's just zero saying, oh look, here's the invoice reminder. If it says something more personal and you say, oh please, you've got your header on it and things like that, that's a bit more professional and nicer looking. And a lot of people you'll find if they get a reminder one week and they go on the next week, they should pay. If you are doing it manually, there's ones that can be missed. I've seen it in other firms where people just look to chase the bigger ones, whereas if you've got all the small people to pay, it all accumulates. By leaving those smaller ones, they're the ones you probably do a lot more work for less money. Why not get them to pay and then decide whether you need to keep them on board or not?
I used to run a business, and our bookkeeper, he had a policy. It was back in the days when you used to have to sign checks and stick them in an envelope and frank them and post them. And on the check run, he'd run the checks on the day that the payments were due, and he'd put all the checks in the envelopes in the drawer, and he'd wait until not the first reminder, but the second reminder, and only then would he actually take it out, and actually he was shrewd, and only then would he frank it and post it. So the key point there is it's not about someone being heavy-handed on the phone. So it's just some people will have a system whereby if they don't get 2 reminders, they won't respond, and it's the he who shouts loudest gets paid in this case. So if you're not sending out the reminders, then it's about having the system and the process, and that system and process being implemented on a systematic basis. My experience in running smaller businesses as well is that when the pressure's on, stuff slips, and things like credit control slips because you're chasing I've got to get the goods on site, I've got to do the job, and credit control can wait, and then suddenly the grief, it's been days and have subsequent impact on debtor days.
Yeah, how many times have we all heard I didn't get it, I didn't see it, the very clever way of pushing you back, which I know we all use, we all use to pay later ourselves, but in order to get our money into our business, I think it's good to have good credit control and focus on debtors first and then work on the rest.
Yeah. There was another one around debtors, isn't it? Is that when does the company, if the company is really managing cash flow, when do they raise a query with the invoice? Well, it's not when they receive it, is it?
No.
At the last minute when it's to be paid, they'll raise the query, and then how long does it take you to sort out the query to make sure everything is actually bang on the invoices? So there's systemization and having someone focusing on it can have a big difference in my experience.
Yeah, and I mean, I know it can cost money even if you do get somebody in to do credit control, but if you think about what they're actually returning it is already sales that's done. But if you think about if you were to write off bad debts for money that you knew people had either retired, something they may have died, they don't want to pay anymore, they can't pay anymore. There's so many. It's a cheaper option to get somebody to do that. It really is. Because writing it off is you've normally paid the tax on it at a certain point in time, you've gone to the next year, then you're writing it off, then you claim it back the year after. It can take 24 months before you actually see your benefit of writing it off. So yeah, if you haven't utilized things like Xero and other credit control functions, then it's always good to, and then you can always change your creditor days. So when you put your invoice, don't put 14 days, change it to 10. just see how that works. Any other questions?
It's interesting the figures on how remote chance you'd ever have of selling your business.
Yeah,
That's
it is quite
frightening.
staggering how
Yeah,
small, how small the number is that you can actually get your business to be sellable. But I suppose by doing all of this, if you don't have your business set up correctly, it's always going to be harder to sell it.
yeah.
A lot of businesses just think in 3 years' time, I'm going to sell it. And that doesn't work, because most investors and things like that need to see what happened the last 2 years, make sure the data's right, there's no fraud, there's no errors. So if you don't look at these sort of things, and if you have massive debtor days and you have overdrawn loan accounts, it's never going to sell. And I think that's where people get to. They think, oh, I've got an overdrawn balance sheet. Someone will buy it for what the assets are worth, but it doesn't always work out like that.
Absolutely.
So by giving yourself time to thinking about selling now and giving yourself that 5-year plan, you can sort everything out in that time.
Hey, Dave, I'm going to jump off in a minute. What did you say you were covering next week?
So we're just going to get to the next one. So, right, so I'm just going to go key takeaways from this. So the key takeaways here, guys, are to focus on the areas that matter and create the least stress. So building the business is a great idea, but ensure you are being paid for the work you conduct and in a timely manner. Remember, your creditors require payment from you quickly enough, so why not do the same to them? So thanks for the time and attention today, guys. We've now completed session 1. Next week, we will explore the business drivers in more detail to illustrate how tiny incremental improvements over time deliver a stunning impact on business performance to you. And if you've not already done so, please go to the website and register your name for the next session. If there's any problems with the password or anything, do let me know. I'm going to change it so that it pops up straight away. And finally, if you're serious about growing or simply improving your business, there's some homework for you. So what are your 5-year goals for both business and personal life? And what are your business growth drivers? What were they last year and what were they the year before that? So we're just going to ask you to write some things down, and next week we can discuss in the meeting. So yeah, thanks for coming along, guys. Really appreciate everyone coming along. And yeah, I'll put this on the website if anyone wants to watch it again afterwards. But if you've got any other queries, either give me a shout now, or just give us a call at the office anytime, and we can run through.
Thank you. That was brilliant.
Thanks so much, everyone. Thanks a lot.
Yeah, great. Thank you. Have a good week.
All right, guys. Thanks for coming along.
See you back.
Good day. Cheers, mate.